Imagine waking up one morning, checking your portfolio, and watching Bitcoin climb hundreds of dollars every single hour. That feeling, that electric mix of excitement and disbelief, is what millions of crypto investors experienced recently. And the question on every serious trader's mind right now is this: is this the beginning of something much, much bigger? Welcome to Crypto Hub, your trusted source for the most critical developments in the digital asset space. Today, we are diving deep into one of the most significant market events of the year. Bitcoin is surging. Institutional investors are returning in force, and the signals coming out of the market right now are unlike anything we have seen since the last major bull cycle. If you have been waiting for confirmation that the tide is turning, you need to pay close attention to everything we are about to break down for you, because the data, the on-chain signals, and the macroeconomic shifts are all pointing in the same direction. Let us start with the raw numbers, because before we can talk about what this surge means, we need to understand what actually happened. Bitcoin broke through several key resistance levels in a compressed window of time, a move that forced even the most cautious market analysts to sit up and take notice. This was not a quiet, gradual recovery. This was a sharp, high-volume breakout that carried the hallmarks of coordinated institutional buying. When retail investors move markets, you typically see choppy, irregular candles, a lot of noise, and inconsistent volume. What happened here was different. The volume was heavy, sustained, and structured in a way that professionals in traditional finance recognize immediately. Large block orders, minimal slippage, and consistent buying pressure across multiple major exchanges. These are the fingerprints of institutional capital, and they were everywhere. To understand why this matters so deeply, we need to revisit where Bitcoin was just months ago. The market had been moving through a prolonged consolidation phase. Sentiment was cautious. Retail participation had cooled significantly from the peaks we saw in previous cycles. On-chain data was showing accumulation, yes, but it was slow, methodical, and happening quietly in the background. Then something shifted. The macro environment began to change in ways that made Bitcoin significantly more attractive to large-scale investors who had been sitting on the sidelines, watching and waiting for the right moment to re-enter. One of the most critical drivers behind this return of institutional money is the evolving interest rate landscape. For the past several years, high interest rates made risk assets significantly less appealing. When you can park capital in treasury bonds and earn a meaningful yield, the incentive to take on the volatility of crypto is reduced. But as central banks around the world have begun signaling, and in some cases actively implementing rate adjustments, the calculus changes dramatically. Capital starts looking for higher yield opportunities. Bitcoin, with its fixed supply and growing adoption, starts looking attractive again to fund managers who need to generate returns for their clients. This macro rotation is not speculative. It is a well-documented phenomenon that has played out across multiple asset classes, and Bitcoin is now firmly positioned as a macro asset that responds to these global monetary shifts. Now let us talk about the institutional infrastructure that has been quietly building over the past 2 years, because this is perhaps the single most important development that distinguishes this potential bull run from anything we have seen before. The approval and subsequent success of Bitcoin spot ETFs fundamentally changed the accessibility equation for institutional capital. Before ETFs, large funds, pension managers, and corporate treasuries faced significant operational hurdles when it came to gaining direct Bitcoin exposure. Custody solutions, regulatory compliance, reporting requirements, all of it created friction that kept enormous pools of capital on the sidelines even when fund managers were personally bullish on the asset. The ETF structure removed that friction almost entirely. It allowed institutional capital to flow into Bitcoin through familiar, regulated, auditable vehicles that fit neatly into existing compliance frameworks. The result has been a steady stream of inflows that, during this recent surge, turned into something closer to a flood. The inflow data coming from major Bitcoin ETF products has been extraordinary. We are talking about single-day inflow figures that rival some of the most active periods since these products launched. And critically, the redemption rates have remained relatively low, which tells us something important. This is not hot money looking for a quick trade. This is strategic, longer duration positioning. Institutions are building stakes. They are not flipping Bitcoin for a 10% gain. They are allocating as part of a broader portfolio strategy, which means this capital is likely to remain in the market through multiple price cycles, providing a structural floor that simply did not exist in previous bull runs. Corporate treasury adoption is another layer of this story that deserves serious attention. The playbook that was pioneered by a handful of bold companies has now been studied, analyzed, and increasingly replicated by corporate finance teams around the world. The argument is straightforward and growing more compelling by the quarter. If you are sitting on significant cash reserves and you believe that fiat currency will continue to lose purchasing power over time, holding some portion of your treasury in Bitcoin is a rational hedge. The companies that made this move early have seen the value of their Bitcoin holdings appreciate substantially, which has not gone unnoticed by their competitors, their shareholders, or their boards of directors. This corporate adoption trend is still in its early innings, and each new company that adds Bitcoin to its balance sheet adds credibility, reduces stigma, and makes the next company's decision slightly easier. Let us now examine what the on-chain data is telling us, because blockchain analytics have become one of the most powerful tools available for understanding the true state of a market. One of the most bullish signals visible right now is the continued decline in Bitcoin held on exchanges. When Bitcoin moves off exchanges and into cold storage or long-term custody wallets, it signals that holders are not preparing to sell. They are preparing to hold, often for extended periods. This reduction in exchange supply, combined with the increased demand from ETF inflows and corporate buyers, creates a supply squeeze that historically precedes significant price appreciation. The math is not complicated. If the number of Bitcoin available for purchase on the open market is declining while demand is increasing, price must adjust upward to find equilibrium. Another critical on-chain metric worth examining is the behavior of long-term holders, often defined as wallets that have not moved their Bitcoin in at least 155 days. This cohort controls an enormous percentage of the total circulating supply, and their behavior is one of the most reliable indicators of market sentiment among the most experienced participants. Right now, long-term holder behavior is consistent with the early to middle phases of a bull market. They are not distributing heavily. They are holding and, in many cases, accumulating. This stands in stark contrast to the late-stage bull market behavior we saw at previous cycle peaks, where long-term holders began systematically transferring Bitcoin to exchanges in preparation for distribution to new buyers entering the market at elevated prices. We are not seeing that pattern right now, which is a meaningful signal that experienced market participants do not believe we are anywhere near a cycle top. The hash rate, which measures the total computational power securing the Bitcoin network, is also at or near all-time highs. This is significant for several reasons. A high and rising hash rate indicates that miners are investing in infrastructure, which they would not rationally do if they expected the Bitcoin price to decline substantially. Miners have direct exposure to the Bitcoin price through the coins they earn as block rewards, and their capital allocation decisions are a real-world vote of confidence in the asset's future value. The robustness of the network at this hash rate level also reinforces Bitcoin's security proposition, which is one of the key arguments that institutional risk managers use when evaluating the asset as a store of value. Now, one of the most discussed aspects of the current market environment is the post-halving dynamics. For those who may need a refresher, Bitcoin's protocol includes a halving event approximately every 4 years, at which point the reward paid to miners for processing transactions is cut in half. This directly reduces the rate at which new Bitcoin enters circulation. The most recent halving reduced the daily issuance of new Bitcoin significantly, meaning the market must absorb the same or greater demand with a reduced supply of new coins entering circulation. Historically, the 6 to 18 months following a halving have been associated with some of Bitcoin's most dramatic price appreciation periods. The mechanism is straightforward supply economics, but the timing and magnitude of the response has varied across cycles. What appears to be happening now is consistent with the post-halving demand acceleration that preceded previous major bull markets, but with a crucial difference. The institutional infrastructure absorbing this demand is far more developed than in any prior cycle. It would be intellectually dishonest, however, to present only the bullish case without acknowledging the risks and the complexities involved. No discussion of a potential bull run is complete without a clear-eyed assessment of what could go wrong, and at CryptoHub, we are committed to giving you the full picture. regulatory risk remains a real and dynamic factor in the Bitcoin market. While regulatory clarity has improved in some jurisdictions, particularly with the institutional-grade frameworks developing around ETF products, the global regulatory environment remains uneven. A significant adverse regulatory action in a major market could dampen sentiment and create short-term selling pressure. This does not change the long-term fundamentals, but it is the kind of external shock that can create painful corrections even in the context of a larger bull market. Macroeconomic uncertainty is another variable that cannot be ignored. While the trend toward monetary easing has been a tailwind for Bitcoin, the global economy remains complex and unpredictable. Unexpected inflation data, geopolitical events, or disruptions in traditional financial markets can all affect risk appetite in ways that temporarily reduce demand for assets like Bitcoin, even when the long-term outlook remains constructive. Experienced investors understand that bull markets are not straight lines. They are characterized by significant volatility, including sharp corrections that can shake out over-leveraged positions and test the conviction of newer participants. The ability to maintain perspective during those corrections, to see them as temporary disruptions within a larger trend rather than evidence that the trend is over, is one of the most valuable skills a crypto investor can develop. The psychological dimension of market cycles is also worth addressing directly because it is a factor that has cost countless investors significant returns in previous cycles. The pattern is familiar. Prices rise, skeptics are converted into believers, latecomers pile in near the top, prices correct, newly converted believers capitulate and sell at a loss, and the cycle resets. The institutional participation we are discussing today does not completely eliminate this dynamic. Retail sentiment cycles will continue, but it does provide a more stable foundation. Large institutional holders with long investment horizons do not panic sell at the first sign of a correction. Their presence in the market as substantial holders helps absorb selling pressure and reduces the severity of drawdowns relative to what we might otherwise see in a purely retail-driven market. Looking at the broader ecosystem beyond Bitcoin itself, the signal coming from network activity and developer engagement is also consistent with the early stages of a new growth cycle. Layer 2 solutions built on top of Bitcoin are maturing. The infrastructure for decentralized finance on Bitcoin-adjacent rails is expanding, and the overall narrative around Bitcoin as a legitimate global asset, not just a speculative vehicle, but a serious institutionally recognized store of value, continues to strengthen with each passing quarter. This narrative evolution matters because it affects the pool of potential buyers. Every institutional investor, sovereign wealth fund, or national treasury that moves from skepticism to serious consideration represents a potential future source of demand that has not yet entered the market. The comparison to previous bull cycles is instructive here, but we want to be careful not to rely on historical analogies too rigidly. The crypto market has matured substantially. The participant base is different. The infrastructure is different. The regulatory environment, while still evolving, is more developed. These differences mean that while historical patterns can serve as useful reference points, this cycle is likely to have its own distinct characteristics. The pace of the move, the depth of corrections, the ultimate price discovery range, all of these could differ meaningfully from what we observed in 2017 or 2020. What we can say with reasonable confidence is that the underlying drivers of demand, institutional adoption, fixed supply, post-halving dynamics, and macro-monetary conditions, are all present and aligned in a way that historically has been associated with significant upside for the asset. For investors who are currently positioned in Bitcoin and watching this surge unfold, the critical question is one of strategy and risk management. At Crypto Hub, we consistently emphasize that managing risk is not a bearish activity. It is the foundation of sustainable long-term returns. Having a clear framework for your position size, your time horizon, and your response to different price scenarios is not pessimism. It is professionalism. The investors who navigate bull markets most successfully are typically not the ones who take the most aggressive positions. They are the ones who take thoughtful, well-sized positions that allow them to hold through volatility without being forced to sell at inopportune moments. For those who have been on the sidelines and are now watching this move with a mixture of excitement and anxiety about having missed the entry, the most important thing to remember is that a potential bull run does not typically play out in a matter of weeks. Major Bitcoin bull cycles have historically been multi-quarter, sometimes multi-year affairs, with numerous opportunities to participate. The fear of missing a move is one of the most dangerous psychological traps in investing, and it leads to poor timing decisions that undermine long-term returns. A disciplined, research-driven approach to building a position is almost always superior to a panic-driven rush to catch a running price. The bigger picture here, the one that extends beyond the immediate price action and the short-term excitement of a surge, is the continued integration of Bitcoin into the fabric of the global financial system. Every major fund that allocates to Bitcoin, every corporation that adds it to its treasury, every regulatory framework that provides institutional-grade clarity is a brick in a structure that is becoming more durable and more significant with time. The question of whether Bitcoin is a legitimate global asset is, for an increasing proportion of the world's most sophisticated investors, no longer a debate. It has been settled. The question now is one of degree. How large a role does Bitcoin play in the global financial system? And based on everything we are seeing right now, that role is expanding. This has been a comprehensive breakdown of one of the most important market developments of the year, and the implications of what is unfolding right now extend far beyond a single price move. At Crypto Hub, our commitment is to bring you the rigorous, in-depth analysis that helps you understand not just what is happening, but why it is happening, and what it means for you as an investor and a participant in this space. If you found this analysis valuable, make sure you are subscribed to Crypto Hub so you never miss a critical update. Share this with someone who needs to hear it, leave your thoughts and your questions in the comments below, and as always, stay informed, stay strategic, and stay ahead. This is Crypto Hub, and we will see you in the next one.